Canada's trade numbers for April are in, and they are raising some serious concern. Exports to the U.S. plunged as new tariffs take a toll.
Australia's economy is facing major challenges.
It's never been more expensive to build a house, according to new figures out today.
In Australia, an average home now costs 8 times the median household income. In Canada, it's nearly the same. Home buyers would have to contend with mortgage repayments of over half their income. Yet both nations rank among the top 10 wealthiest countries by GDP per capita. How can two of the richest nations in the world feel increasingly unaffordable and even unlivable to their middle class? How did prosperity become a mirage and not a promise? Behind the shining statistics and polished headlines, something far more disturbing is unfolding. This is not just a story about numbers, but a quiet revealing of what it means to be rich in the modern world. At a glance, Australia and Canada look like a dream. Both sit in high global rankings for GDP per capita, around $70,340 for Australia and $63,419 for Canada as of 2023. Their cities consistently top quality of life indexes, their currencies are stable, their banking systems are sound, and their job markets, at least on paper, are steady. But ask the average resident in Toronto or Sydney how they're doing, and the answer will likely come with a tired sigh or a nervous laugh. Because numbers don't tell the whole story. In fact, they might be hiding it. Let's start with the cost of living. Over the last 2 decades, prices in both countries have quietly, and in some cases, rapidly, outpaced income growth. In Canada, for example, between 2000 and 2022, average wages increased by roughly 27%, while household prices surged by over 300%. In Australia, it's even worse. In Sydney and Melbourne, home prices have risen more than 100% in the late 1990s, while real wages have remained nearly flat over the same period. This means a person who once needed 5 years of income to buy a home in the capital city now needs 10 or more. In Vancouver, the average home now costs over 1.2 million Canadian dollars. In Sydney, it's over 1.4 million Australian dollars. These aren't luxury homes, but are often modest 3-bedroom houses in outer suburbs. The very idea of home ownership, which was once the foundation of middle-class life, has become out of reach for entire generations. Millennials and Gen Z in both countries are staring at a future filled with debt, high rents, and a growing sense that they'll never catch up. But the problem isn't just housing. Groceries, childcare, insurance, and transportation have all surged in price. A recent 2024 survey by Finder Australia found that more than 70% of Australians are unsatisfied with their lives and struggling with basic living expenses. In Canada, a StatCan report from March 2024 revealed that food bank usage reached an all-time high, with more than 2 million visits nationwide, the highest figure since data began being recorded. All of this is happening in economies that are supposedly thriving. So why the disconnect? Part of the problem lies in how we measure economic health. GDP per capita averages the national output per person, but it doesn't reflect distribution. A mining boom in Western Australia or an oil export spike in Alberta can raise national GDP while leaving entire regions behind. Wealth has become more concentrated in both nations, and the so-called growth has failed to touch millions of lives. A handful of corporate profits or commodity spikes might look great on paper, but they do little for a family scraping by in suburban Calgary or regional New South Wales. Middle-class security, once the hallmark of both countries, is no longer guaranteed. The wages of most workers, while stable, aren't growing fast enough, and income equality has widened more than ever. Real estate investors, corporate giants, and resource exports are capturing a growing share of national wealth, not workers. And unlike the United States, where widespread stock market participation helps boost personal wealth, most Canadians and Australians have far fewer investment vehicles to offset the rising living costs. Superannuation and pensions exist, yes, but they're not enough to bridge the growing affordability chasm. And then there's debt. Personal debt in Australia is among the highest in the world, hovering near 185% of disposable income in 2024. In Canada, it's over 180%. People are not living within their means, rather they're borrowing to survive. Mortgages, credit cards, car loans, and buy now pay later schemes are now structural pillars of daily life. But what happens when interest rates rise? We already know, and it's not pretty. In 2022 and 2023, the Reserve Bank of Australia and the Bank of Canada both aggressively raised interest rates to battle inflation. The result? Monthly mortgage payments for variable rate holders shot up by hundreds of dollars. This leads us to the emotional core of the crisis. It's not just about affordability, it's about dignity. What does it mean to work hard, follow the rules, save money, and still fall behind? In both countries, a growing number of citizens feel like they're running a race where the finish line keeps moving further away. The dream of owning a home, starting a family, and retiring with security feels like a cruel joke. But are they? If people are earning more but keeping less, if homes are appreciating but becoming unreachable, if wages are stable but lives are unstable, then perhaps the problem isn't the people, it's the system, but that's not all. Now let's peel back another layer of this crisis. One that sits deep beneath the soil and flows through the pipelines of both countries: commodities. For over a century, Australia and Canada have relied on extracting and exporting natural resources to power their economies. This has made them wealthy, but it has also made them vulnerable and perhaps even complacent. In Australia, iron ore is king. The country controls about 54% of the global seaborne iron ore market, with much of it shipped straight to China. In 2024, Australia exported over $142 billion in iron ore. When you add coal, natural gas and lithium, you have a resource sector that contributes about 11% of its GDP and underpins hundreds of thousands of jobs. But what happens when global prices fall? What happens when the buyer slows down? When China's economy cooled in 2022 and 2023, demand for iron ore dropped, prices dipped, and Australia's export revenues saw significant setbacks. The same happened during the 2015 commodity crash. This is the curse of being a commodity-heavy economy. You're always at the mercy of markets you don't control. Canada tells a similar story. Alberta's oil sands are massive and home to the 4th largest proven oil reserves in the world. But oil is a very volatile resource. Prices crashed in 2008, then again in 2014, and then went negative in 2020 during the COVID-19 pandemic. For example, some towns built around oil, such as Fort McMurray, have boomed and busted more than once in the past 15 years. And with the global push for decarbonisation, Canada's reliance on oil is becoming riskier by the day. Meanwhile, neither country has done nearly enough to diversify its dependency. Yes, they've dabbled in tourism, education and financial services. But in terms of building a globally competitive high-tech, value-added industrial sector, they're still playing catch-up. Unlike Germany, Japan or South Korea, which invested heavily in manufacturing and R&D. Australia and Canada largely stuck with what was easy: dig it up, ship it out, and count the profits. But now, these profits are uncertain as the world is beginning to change. Clean tech, AI automation, and digital services are the new gold. And yet both nations are still running economies that look a lot like they did in the 1980s, just with shinier data centers. So why didn't they change course sooner? When money is flowing, no one wants to ask hard questions. When China was buying coal by the megaton, when oil was trading at $100 a barrel, everything looked fine. But those days are over. Or maybe not for both countries. You might want to ask, is there a way forward? Let's find out. Let's begin with the numbers. According to the World Bank's Innovation Scoreboard, Canada ranks 1.55% in R&D spending as a percentage of GDP in 2022. While Australia sits at 1.83% in 2019. That's far behind countries like South Korea, Israel, Germany and Sweden, nations that spend well over 3% of their GDP on research and development. Canada sits around 1.7% and Australia is slightly higher at 1.8%. The gap is not just academic, it's consequential. It means fewer innovations, fewer patents and fewer competitive tech firms emerging at a global scale. The problem isn't a lack of talent either, as both countries have some of the world's best universities, such as the University of Toronto, the University of British Columbia, Monash, UNSW, and the University of Melbourne, to name just a few. These institutions graduate thousands of engineers, scientists, and researchers each year, but many of them choose to stay in other countries. Why? Because the private sector isn't absorbing them enough. There's a pipeline leak between education and economic application. Instead of staying to launch startups, many of Canada's and Australia's best minds are heading to the United States to work in Silicon Valley, or to Europe's emerging tech hubs. A 2022 report from the Brookfield Institute revealed that 25% of Canadian STEM graduates leave the country within 5 years. In Australia, the story is similar, with brain drain especially concentrated among highly skilled software engineers and biotech specialists. So, what's stopping the growth of homegrown tech? In part, it's the market structure. Both economies are dominated by a handful of large incumbents, particularly in sectors like banking, telecommunications, groceries and insurance. In Australia, the big four banks, CBA, NAB, ANZ and Westpac, hold a chokehold on the country's lending and financial services. In Canada, RBC, TD, Scotiabank and BMO do the same. These mega institutions make record profits, but they're not known for risk-taking or investing heavily in early-stage innovation. It's a similar story in telecoms. In Canada, Bell, Telus and Rogers essentially carve up the national wireless market, which results in some of the highest mobile data costs in the OECD. In Australia, Telstra, Optus and TPG dominate the scene, and this kind of oligopoly discourages disruption. Why invest in new entrants when the barriers to entry are almost impossible to scale? In a truly dynamic economy, competition fuels creativity, but in Canada and Australia, it's often stifled before it starts. Now, let's talk about global tech presence. Where are the Shopify-level companies of Australia? Where are the Atlassian-scale firms of Canada? Shopify, a Canadian e-commerce giant, is a rare success story, but even it has struggled in recent years. Atlassian, an Australian-born success in enterprise software, is now headquartered in the United States, with most of its employees, leadership and investment flows now based outside its home country. Venture capital is another problem. Australia is expected to reach a total capital raised of $705 million in the venture capital market. Meanwhile, nearly $2.4 billion in total VC funding was deployed into Canadian technology startups. In contrast, the United States has poured over $160 billion into venture capital over the years. The gap is enormous. And without this risk capital, startups don't stand a chance. If Australia and Canada continue down this path, they won't just be stuck in the past, they'll be priced out of the future. Another disturbing trend is the immigration paradox. On paper, immigration is one of the strongest pillars propping up both the Canadian and Australian economies. In Canada, nearly 1 in 4 residents is an immigrant, making it the highest proportion of any G7 country. Australia isn't far behind, with 29% of its population born outside Australia. These numbers have driven population growth, consumer demand, and labour market expansion, which are all critical ingredients in national prosperity. But there's a catch. While immigration helps grow the top line, neither country has done enough to prepare for what it means at the street level, such as housing, healthcare, transportation, and schools. Let's begin with housing. A big part of this is simple supply and demand. New immigrants who often settle in urban centres increase housing demand, but housing supply has not kept up. Building approvals in both countries have slowed due to regulatory bottlenecks, zoning restrictions, and construction costs. The result is a housing crunch that affects everyone, not just newcomers. This spills over into rentals as vacancy rates in some Canadian and Australian cities are near record lows. In Toronto, rentals for a one-bedroom apartment hit an average of $2,500 Canadian dollars per month in early 2024. In Sydney, it was around $700 per week. These are unaffordable prices for most workers, especially for young and new arrivals who are still trying to get a foothold. But it's not just housing. Healthcare systems are also under immense pressure. In Canada, the average wait time for a specialist appointment exceeded 27 weeks in 2023, making it the longest ever recorded. Emergency rooms in both countries are frequently overwhelmed. Family doctors are in short supply, particularly in suburban and rural areas. Simply put, the infrastructure hasn't expanded at the pace needed to accommodate the rising population numbers. Public transit is another pain point. Melbourne and Toronto's transit systems are becoming outdated, overcrowded, and underfunded. Expansion projects are constantly delayed, and the same goes for schools, where growing class sizes and resource shortages are becoming common in high-growth suburbs. The paradox here is clear. Immigration is driving economic numbers higher, but the quality of life is slipping for both long-term residents and newcomers. As such, economic strain builds, so does social tension too. If nothing changes, the very immigration policies that once seen as an economic advantage will become a political liability. Thank you for watching. Please like this video and hit the subscribe button. You sure won't want to miss what we have for you going forward. See you in the next video.